Here's what actually happens to two people with the same salary, the same city, the same entry-level job, the same Monday morning. One of them retires at 58, not because the company forced him out, but because the spreadsheet told him he could, with over $3 million in net worth and $3,000 per month in real estate, cash flow that arrives whether he gets out of bed or not. The other one is sitting at a desk at 67 at a company he didn't choose, calculating whether the Social Security check covers the gap between what he saved and what rent costs. The distance between these two outcomes is not a career difference. It is not income. It is not luck. It is 1 decade, their 50s. And the thing that decided it on both sides was not a single dramatic choice. It was a system. So which side of that system are you currently building? Your 50s are the last real compounding window before the runway runs out. Most people treat that decade as a reward for surviving the previous 3. The truck they always wanted, the kitchen renovation, the apartment upgrade now that the kids are mostly gone. And that spending impulse is precisely when the retirement gap goes from recoverable to structural. I'm going to walk you through what that gap actually looks like in numbers, what creates it beneath the surface, why the conventional advice most people receive in their 50s is structurally late by 15 years, and what a real building strategy looks like at this stage, not in slogans, in mechanics. The financial advisor who shows up at 50 with a target date fund recommendation and a portfolio review, I'm going to come back to him. He's doing his job. His job arrived 15 years late. That's the problem. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Here's the metaphor. Your financial life is a plane trying to take off. The runway is time. Compounding is the engine. Every decade, you spend building, investing consistently, reducing structural debt, creating income streams. Before you need them, you are laying runway behind you and generating airspeed. By your 50s, you cannot lay down more runway behind you. What exists is what exists. Your only job from 50 to 65 is to stay on the tarmac, keep the throttle open, and not swerve. The people who spend their 50s rewarding themselves, they swerve. Sometimes they swerve directly into a field, and the field looks fine from a distance until the landing gear comes down and there's nowhere to go. Hold that image. The runway comes back. In a few minutes, I'm going to walk you through what happens to the withdrawal math when the market has a bad sequence in your first 3 years of retirement. It is more destructive than almost anyone in the financial media explains clearly. But first, I need to establish why your 50s are mechanically unlike any other decade. Because most people have heard that the 50s matter without ever running the actual numbers on what is legally available to them, right? Now, the Bureau of Labor Statistics consistently shows that the 55 to 64 age cohort earns more in median weekly wages than any earlier working cohort. Your 50s are peak income. That is meaningful on its own. But stack this on top. As of 2025, if you are 50 or older, you can contribute $31,000 annually to a 401k. That is the standard limit of $23,500 plus a $7,500 catch-up contribution that exists exclusively for people over 50. You can also contribute $8,000 to a Roth IRA, $7,000 standard, $1,000 catch-up. Combined $39,000 per year in tax-advantaged space. That is a legal mechanism sitting in your name right now. Most people have heard about it. Most people do not use it at anything close to full capacity. Here is what it actually produces in real money. Take a 50-year-old with $300,000 already saved. They max the catch-up, 401k, at $31,000 per year from their own income. Add a 4% employer match on a $75,000 salary, $3,000 more per year. Add the Roth IRA at $8,000 annually. Total invested per year, $42,000 at 7% average annual return for 15 years. That person arrives at 65 with approximately $1.85 million. Now take the same person, identical starting balance, same 15 years, same market, but instead of maxing contributions, they save at the median rate implied by Vanguard's 2023 How America Saves report. which shows median 401k balances for workers 55 to 64 of approximately $87,500, suggesting ongoing contributions for mid-income earners of roughly $350 per month. That person arrives at 65 with approximately $890,000. Same starting point, same 15 years, nearly $1 million in difference. Every dollar of that gap traces back to how much of the available runway they used. You might think the problem is that people don't know about catch-up contributions. 3 separate podcasts explain them in the last year alone. That is not the issue. The issue is the expense structure most people have assembled by the time they reach 52 or 53. Behavioral economists call it the ratchet effect. Spending ratchets up with income and almost never ratchets back down without an external shock. Every raise through the 40s funded something real, a better apartment, a newer car, vacations that felt earned, costs associated with children who were genuinely expensive for 2 decades. Each individual decision was defensible. Collectively, they built a cost structure that leaves no room for the catch-up window to operate. When income grew, spending followed by default. The money was spoken for before the window even opened. This is not a character problem, it is inertia. And inertia is the actual adversary here, not lack of information. There is a compounding tail on this that most people never see until it lands. A dollar invested at 50 has 15 years to work before 65. A dollar invested at 30 had 35 years. Same market, same fund, same dollar. The 30-year-old's dollar produces 4.1 times more wealth at 65. Your 50s are where most people finally start the clock in earnest. The math does not pause while you decide if you feel ready. This is where it gets really interesting. And this is the part most retirement conversations miss entirely. You think the cost of spending your 50s instead of building is a smaller account balance at 65. That is the visible cost. The invisible cost, the one that actually reshapes your daily life, is what a thin balance does to every decision you are legally and financially allowed to make after 62. Those are not the same thing. At 62, the Social Security Administration gives you a choice. Take your benefit now or wait. For anyone born in 1960 or later, full retirement age is 67. Take the benefit at 62 and you receive 70% of your full monthly benefit permanently. Wait until 70 and you receive 124%. On a $2,000 monthly full benefit, representative of a median income working career, the difference is $1,400 versus $2,480 per month for the rest of your life. For someone in reasonable health who lives to 88, waiting to 70, produces roughly $130,000 more dollars in total lifetime Social Security income on that $2,000 benefit. For higher earners, proportionally more, the math on waiting is almost always correct, if you can afford to wait. But here's the trap. The person who spent their 50s, who arrives at 62 with a thin account and a monthly budget with no margin, cannot afford to wait. The Social Security check is not optional for them. They take it at 62, they lock in the 70% permanently, they live on it, and that decision was not made at 62. It was made at 53 when the truck seemed reasonable. It was made at 56 when the vacation went on a card that took 9 months to clear. It was made at 59 when the adult child needed help with a security deposit and the money came from savings instead of real estate cash flow. Your 50s don't set your retirement account balance. They set the decisions you are financially allowed to make a decade later. That is the invisible cost. The account number is what people measure. The optionality is what determines the quality of the rest of your life. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Let me give you a parable. A man I'll call Henry. 30 years as a project manager for a regional construction firm. Solid income, consistent career, genuine work ethic. His philosophy about money was uncomplicated. He worked hard, he deserved the good life, and he'd figure out retirement when he got there. When he got there, turned out to be 57. When a corporate acquisition eliminated his position, 11 weeks of severance, $8,200 after taxes. 401k balance, $62,000. Monthly mortgage, $2,400. He found a new job in 6 weeks, $14,000 a year less. He told himself, It was temporary, he would make it up, things would normalize. At 62, the Social Security check became structural to the monthly budget. He took it early. 14 months later, the equity market pulled back 18%. His 401k, which he was already drawing from monthly to supplement the income gap, fell from $89,000 to $72,000 while he was making withdrawals. He did not get to choose the timing. Nobody does. Henry is not a failure. He is a systems story. The system he built through his 50s was optimized for comfort and present standard of living. It was not optimized for optionality, the capacity to make the better decision when the better decision requires a financial cushion and the patience to wait behind it. Optionality is what lets you decline Social Security at 62. Optionality is what lets you hold an equity position through a bad market year instead of selling at the bottom to pay rent. You build optionality in your 50s, or you discover its absence at 63. And you find out which scenario you're in when the market decides to test the architecture you built. Now let me show you the other side of spending your 50s. Because when I say spending your 50s, I don't always mean a second home or a boat. Sometimes the drain is quieter than that. Sometimes the most expensive thing you bought in your 50s was a pattern. The Kaiser Family Foundation tracks employer-sponsored health insurance premiums every year. In 2024, the average annual premium for family coverage was $25,572. Your employer pays most of it. You don't feel it move through your checking account. Here's what happens when you leave the job at 60 or 62 before Medicare eligibility at 65. You fund that cost yourself. Affordable Care Act Marketplace benchmark. Plans for a 60-year-old run between $13,000 and $20,000 annually, depending on your state and your income level. That is between $1,080 and $1,667 per month in premiums before a single deductible, copay, or prescription cost is added. A couple I'll call the deans retired at 61 and 60 with $600,000 in combined savings. They modeled the 4% rule, the math cleared on paper, and they stopped working. What they did not model was the 5-year healthcare bridge to Medicare. Their actual annual healthcare cost premiums, copays, and one outpatient procedure averaged $22,000 per year. They had modeled $8,000. The unmodeled gap, $102,000 in costs over 5 years, withdrawn from a portfolio during the exact window when you least want to be drawing at an accelerated rate. They are functional. They work part-time to reduce the withdrawal rate. Functional is not what they planned. That is one hidden drain. Here's another one that appears on almost no retirement planning spreadsheet. The Pew Research Center found that approximately 47% of Americans between 45 and 64 are simultaneously providing financial support to aging parents and to adult children. The average annual cost contributions toward a parent's care, supplementing an adult child's rent, emergency family transfers runs between $8,000 and $15,000 per year, depending on the family. Call it $12,000 per year over a decade of your 50s. That is $120,000. At 7% over 15 years, that same $120,000 invested at 50 would have grown to $331,000 at 65. The emotional accounting of helping your family is zero. Of course you do it. The mathematical accounting runs in the background regardless of the emotional accounting. And then there is gray divorce. The divorce rate among Americans over 50 has roughly doubled since the 90s, according to Pew Research data. The Rand Corporation estimated that gray divorce reduces household wealth by approximately 50% on average, because 2 separate households must now be funded from an asset pool that previously supported one. At 55, with $400,000 in combined net worth, a gray divorce exits both parties with approximately $200,000 each. Not catastrophic, but the wealth-building decade you need to execute now runs without a second income, often with a restructured cost structure, often with legal costs attached. People recover from this. It changes the geometry of the runway significantly. The field gets closer. None of these drains are exotic risks. All 3 are ordinary American life events that occur with statistical regularity in the 50 to 65 age band. The people who built strong, diversified income structures through their 30s and 40s rental cash flow, dividend income. A large asset base can absorb all of them from cash flow without touching principal. The people who didn't have to choose between the family obligation and the retirement account, and the compounding tail runs regardless of which choice they make. The gap I'm about to show you in actual numbers is larger than most people expect. Not because I'm dramatizing it, because the math is patient and it has had decades to accumulate. Path A at 50. This is someone who started building at 22. By 40, they had approximately $1 million in total net worth investment accounts, plus real estate equity, built through consistent automated investing and multiple income properties acquired over the decade. Over the 40s, with continued contributions and compounding on a growing base, real estate cash flow partially reinvested, they arrive at 50 with approximately $2.3 million in total net worth, roughly $2 million in liquid investment accounts, $300,000 in real estate equity across multiple properties. The salary is now over $100,000 per year. At 50, they immediately begin maxing the catch-up limits. $31,000 to the 401k, $8,000 to the Roth, employer match on top of that. The real estate produces roughly $3,000 per month in net income. At 55, total net worth exceeds $3 million. 4% of $3 million is $120,000 per year. Their current annual spending is $82,000. The surplus, $38,000 per year, is the buffer, the market correction buffer, the healthcare emergency buffer, the gray divorce buffer, the adult child crisis buffer. They have it. At 58, they stop going to the job. Not from a philosophy about freedom, from an arithmetic conclusion that held under 3 different stress scenarios. Path B at 50. At 40, net worth was approximately $58,700, mostly a partially recovered 401k and a thin savings account. In the mid-40s, they cleared consumer debt and got more serious about contributions. By 50, investable assets total approximately $240,000. They begin contributing $15,000 per year to the 401k real effort, not the maximum. At 7% over 10 years from that $240,000 base, plus $15,000 per year. At 60, the account holds approximately $580,000. At 4% withdrawal, that's $23,200 per year from the portfolio. Social Security at 62, which the budget requires because there is no other income stream to bridge the gap, adds approximately $14,700 per year on a median full benefit reduced permanently by 30% for early claiming. Total retirement income, $37,900 per year, against a median annual expenditure for Americans over 65 of approximately $57,000. The gap is $19,100. Every year, that gap fills through spending cuts, principal draws, or part-time work. When you draw principal faster than the portfolio grows it, the account is on a one-way clock. When that clock reaches 0, you are in your late 70s or early 80s, and the decisions are not gentle ones. The gap at retirement between Path A and Path B exceeds $2 million. 2 careers, similar incomes for the past 15 years. The divergence happened at 22 and compounded silently through every decade that followed. The 50s reflected what had been built. The 60s revealed the ledger. Neither person understood the ledger while it was forming. They both felt fine at the time. I mentioned the financial advisor who shows up in your 50s. Let me name him, Carl. Carl has 32 years in the business, licensed, credentialed, and genuinely well-intentioned. His advice to clients in their 50s is technically correct by industry standard. Maximize the 401k. Pick a target date fund matched to your retirement year. Maintain 6 months of expenses in cash, and don't take Social Security before full retirement age. Every one of those recommendations is right, and every one of them arrives approximately 15 to 20 years after the decisions that actually built or failed to build the retirement outcome. The choices that created Path A versus Path B, the loan at 22, the lifestyle ratchet through the 30s, the thin savings rate through the 40s, happened before Carl was in the room. Nobody was in the room for those. The conventional financial planning industry is structured to manage assets, not to build them. Carl enters the relationship when there are assets to manage. He optimizes from that point forward. Carl's firm charges 1% of assets under management annually on $400,000 in assets. That is $4,000 per year. Over 15 years of retirement, compounded at 7%, that fee costs the client approximately $97,000 in foregone growth. Not because Carl extracts unfair value, because the incentive structure rewards him for gathering assets and charging a percentage, not for showing up 15 years earlier when the consequential decisions were being made carelessly. That is not a moral failing on Carl's part. That is the architecture of the industry. Here is where Carl is actually useful. The clients who arrive at his office in their 50s with real, diversified asset bases, the Path A profiles, get genuine value from the relationship. The decisions at that level require expertise. Roth conversion ladders during lower income years, before required minimum distributions begin, depreciation schedules on rental properties that reduce taxable income by $30,000 annually, Social Security bridge strategy, execution, trust structures for estate planning. Carl is skilled at this level of complexity. The clients who arrive in their 50s with thin accounts get Carl doing his best. Same tools, smaller base. You can optimize a small number in 100 different ways, and it resolves to a small number with better tax treatment. Carl knows this. He doesn't say it directly. He uses phrases like, "We'll work with what we have." That sentence is true. It is also not the same sentence as, "You will be comfortable in retirement." That distinction lives entirely in everything Carl doesn't say during the first meeting. Let me make this concrete with one specific scenario. Call her Diane, 51 years old, single, operations manager at a regional firm, annual salary, $86,000. 401k balance, $140,000. Savings account, $12,000. No real estate, no taxable brokerage, no consumer debt. She paid off the car last year. She has been meaning to get more serious about retirement for 3 years, and this week she finally ran the actual numbers. Scenario 1, current trajectory. She contributes 6% of salary to the 401k. The employer matches 4%. Total annual contribution, $8,600. She adds $200 per month to the savings account. At 65, after 14 years, at 7%, the 401k grows to approximately $555,000. The savings account holds approximately $68,000. Total at retirement, $623,000. 4% withdrawal produces $24,900 per year from the portfolio. Her Social Security full retirement age benefit based on a career at $86,000 per year is approximately $21,000 per year at 67. Total income, $45,900. Against $62,000 in annual expenses, she is short by $16,100 annually. She takes Social Security at 62 instead of waiting, which reduces her benefit to approximately $14,700 per year. Total income drops to $39,600. She cuts annual spending to match that. That is a $22,000 reduction from her current lifestyle. The math holds. It is not the retirement she imagined when she was 43 and assumed the details would sort themselves out. Scenario 2, 3 structural changes starting this month. First, she raises her 401k contribution to the full catch-up limit, $31,000 per year, up from the $5,160 she contributes now. The employer continues matching 4%, adding $3,440. Second, she opens a Roth IRA and contributes $8,000 per year, funded by cutting $15,000 in annual discretionary spending, roughly $1,250 per month across dining frequency, travel pace, and subscription services she had stopped actively using. Third, she does not upgrade her apartment when the lease renews next spring, absorbing a $160 monthly rent increase rather than moving somewhere more expensive. At 65, 14 years later, the 401k holds approximately $1,137,000. The Roth IRA holds approximately $180,000. The savings account continues at $68,000. Total, approximately $1,385,000. 4% produces $55,400 per year from the portfolio. She waits for Social Security until 70 she can, because the portfolio covers the gap years without stress. At 70, her benefit is 124% of the full amount, approximately $26,040 per year. Total annual income at 70, $81,440 against $62,000 in expenses. She has a $19,400 annual buffer. Same person, same salary, 14 years. 3 structural decisions that required no extraordinary income and no complex investment instruments. The most common piece of retirement advice in America is, you should have started earlier. Profound insight. Remarkably actionable. I'm going to put it on a motivational poster with a stock photo of a sunrise and sell it at financial planning conferences. It will outsell everything else at the table. Here's the part that never makes it into a retirement calculator. You can know every number in this video, the catch-up contribution limits, the Social Security timing, math, the sequence of returns dynamic, and it still does not produce a retirement plan that survives contact with reality. Because the interactions between healthcare costs before Medicare, withdrawal sequencing, and sequence of returns risk don't exist in a single accessible place. So I wrote a book called The Exit Code. It's an analysis of 50 years of actual retirement data, not opinion, not the 4% rule, dressed in new graphics, distilled into what I call a mathematical framework for exiting the rat race. 2 specific elements worth flagging because they connect directly to what we've been discussing. First, the dynamic withdrawal method, which replaces the 4% rule with a responsive withdrawal system that adjusts based on how the portfolio is actually performing. So a bad sequence of returns in year 1 does not lock you into an elevated withdrawal rate that depletes the account on a fixed timeline. Second, what I call the 58% rule, the statistical reality that the majority of people who attempt to retire or semi-retire before 62 end up back in the workforce within 4 years, and not because they ran out of money, because they didn't build the buffer architecture that keeps them out. The book explains what that buffer actually looks like in numbers, not encouragement. You can get it through the link in the description for less than 1 dinner out. Every year you delay building this framework is a year compounding works against the plan instead of for it. Now, here is what almost nobody properly explains about the withdrawal phase. Your entire financial education about retirement has focused on accumulation, how much to save, what return to assume, which account to use. Almost nothing in the standard conversation prepares you for what happens the moment you start pulling from the account. That is a structurally different mathematical environment from everything that came before it. And it contains the risk that ends more retirements prematurely than almost any other single factor. Sequence of returns risk works like this. You retire with $800,000. In year 1, the market returns negative 15%. Year 2, positive 12%. Year 3, positive 10%. You're withdrawing 4% of the original balance annually, $32,000 per year. Your portfolio is in dramatically worse shape than if those same 3 years ran in reverse order. Same 3-year average return. Completely different outcome. Because during the down years, you are selling shares at depressed prices to fund withdrawals. Those shares are permanently gone. They do not come back when the market recovers because you no longer own them. The portfolio compounds from a permanently lower base and cannot fully recover even as prices rebound. A Morningstar analysis published in 2023 found that the 4% rule has approximately an 82% success rate over 30 years under realistic current conditions. Flip that number. 18% of the time, following the canonical, professionally endorsed retirement withdrawal strategy leads to running out of money before death. 1 in 5, these are not people who took reckless risks or ignored conventional advice. These are people who followed the standard recommendations, built the savings, and encountered an adverse sequence of returns at a moment when they had no architectural response available to them. The person who built through their 50s, who has a large equity portfolio, real estate income, a Roth IRA accessible without tax consequence, and a Social Security benefit they maximize by waiting, has what planners call buffer assets. In a bad market year, they pull from rental cash flow. They use Roth distributions, They pause equity portfolio withdrawals entirely. The equity portfolio recovers without being sold at the bottom. The person who retired with a single 401k and no other income stream cannot pause. Rent is due regardless of what the market did last month. They sell at the bottom. They lock in the loss. The sequence compresses the account permanently. Both people held the same fund in the same market. The outcome diverges because of architecture. And you build or fail to build that architecture during your 50s. So what does building actually look like in your 50s? Not the vague version. 3 levels in order of actual leverage. Level 1 is expense structure surgery, not budgeting. Budgeting is tracking what you already spent. Expense structure surgery is running a zero-based review of every recurring cost in your life. Mortgage or rent, vehicle payments, insurance bundles, subscriptions, memberships, and asking which of them would survive being deliberately reauthorized from scratch today if you were making the decision for the first time with full information. The average American household in their 50s carries between $3,000 and $4,500 in monthly recurring costs, assembled over 2 decades of incremental, individually defensible decisions that collectively prevent the savings rate from scaling. The target savings rate for someone between 50 and 60 who is building seriously toward retirement is 25 to 35% of gross income. On a $90,000 salary, that is between $22,500 and $31,500 redirected annually to assets, most Americans in their 50s are saving 6 to 10%. The gap is not primarily an income problem. It is a structure problem. You fix the structure before you try to negotiate with the number. Level 2 is tax efficiency stacking. By your 50s, the relationship between your current marginal tax bracket and your expected retirement withdrawal bracket determines which contribution type produces better outcomes for your specific situation. If you are in the 22% federal bracket, which in 2025 applies to taxable income, roughly between $47,000 and $103,000 for single filers, and you expect a lower effective rate in retirement, pre-tax, 401k contributions win by reducing your taxable income now. If you expect similar or higher taxes in retirement common when rental income, large required minimum distributions, and Social Security combine to push your effective rate up. Roth contributions or Roth conversions during temporarily lower income years produce materially better after-tax purchasing power over a long retirement. The difference between a fully taxable and a partially Roth sheltered withdrawal strategy, modeled across 30 years of retirement, routinely produces $200,000 to $350,000 in additional after-tax income for the same gross portfolio. The IRS published every rule involved in this calculation. Nobody is hiding it. Nobody in the standard advice chain is walking you through the optimal execution path either. Level 3 is pre-retirement income diversification. This is the level conventional advice skips most consistently. The 4% rule assumes a single pool of invested assets and a linear annual withdrawal rate. What actually survives sequence of returns, risk, unexpected costs, and a long life is multiple income streams with different risk profiles and different timing. Rental income does not correlate to equity market drawdowns. Dividend income from a diversified fund is structurally less volatile than growth equity. And the Social Security bridge strategy, using portfolio withdrawals to fund living expenses from the day you retire until age 70, then switching to the maximized Social Security check, converts your own capital into a government-backed, inflation-adjusted annuity that pays for the rest of your life. For every year you delay Social Security from 62 to 70, your benefit increases by approximately 6 to 8% per year. There is no other risk-free mechanism in the current market offering 8% guaranteed annual return. The bridge converts your savings into that product. You build these structures in your 50s, or they are not available to someone who didn't. I've heard financial advisors describe the 4% rule as time-tested and reliable, which is technically accurate in the same sense that a parachute opening 82% of the time over 30 years is also technically time-tested and reliable. The runway. By 60, most of it is behind you. The plane is either airborne or still trying to reach rotation speed on tarmac that is running out. Path A is at altitude, multiple systems running, crosswind tolerant, with enough buffer to absorb market downturns, health events, and family emergencies without losing altitude. Path B is still accelerating, calculating what's ahead. Some people in Path B's position do reach rotation speed. It requires maximum throttle, zero deviation, and favorable conditions for the next decade. Path A was built to handle whatever conditions arrive. That is a different posture than betting on favorable conditions. The runway metaphor closes here. The most common retirement sentiment in America is, "You still have time." That is always true until the day it isn't. What changes as the runway shortens is not your ability to invest. It is the time your investments have to compound before you need them. A dollar invested at 50 has 15 years to work before 65. A dollar invested at 30 had 35 years. Same 7% return, same fund, same dollar. 4.1 times the result from the earlier start. Your 50s are where most people finally start the clock in earnest. The math does not care about the reason for the late start. It just runs the numbers. Gerald, from the opening, 64 years old, 390,000 in savings, working again at a smaller company for a smaller title because the math required it. That outcome did not begin at 62 when he took Social Security early. It began at 49 when his salary first crossed 80,000 and the lifestyle crossed it ahead of him. It began at 53 when the renovation felt more important than the investment account. It began at 57 when the corporate buyout came and there was no buffer to give him the option of declining and waiting for something better. Every one of those decisions had a compounding tail 20 years long. The tail is invisible at the moment of the decision. It arrives on schedule regardless. 3 practical takeaways, specific to this decade only. First, calculate your savings rate as a percentage of gross income right now, not net gross. If it is below 20% and you are over 50, you are running a structural deficit against the retirement you believe you're accumulating. That is not a motivation problem. It is a math problem. Identify the 3 largest modifiable recurring costs in your current expense structure and determine concretely what it would take to move that savings rate to 25%. The number has to become real. Approximations don't compound. Second, model the healthcare bridge explicitly and completely. Between your target retirement date and Medicare eligibility at 65, research the actual annual premium, deductible, and out-of-pocket maximum costs for your state, your income level, and your anticipated health utilization for each year of that gap. For most people who retire before 65 without employer coverage, the realistic annual healthcare expenditure falls between $12,000 and $22,000. If your retirement model does not include this as a specific researched line item rather than a rounded estimate, the model is misleading you by omission. Fix the model before you believe the model. Third, run a sequence of return stress tests against your planned retirement date. Not an average return projection, a scenario where the market delivers -15%, -8%, and +4% in your first 3 years of retirement, while you withdraw 4% annually. If that scenario runs the account to 0 before age 82, you do not have sufficient buffer. That buffer is built during your 50s, or you discover it missing during your late 60s, when the discovery is no longer a planning conversation. It is a crisis. Lazy investing built more fortune than crypto memes. The calculator has been running since the day the first paycheck cleared. You cannot change the inputs you already